Well, good day, and thank you for attending our webinar today, and welcome everybody. It's a beautiful day. Hope it is a beautiful day wherever you are. So welcome to us, SW, our final financial reporting webinar for 2024. If you can believe it's the end of the year, I still can't, but it's been a great year, and we've had a number of webinars this year, and it's been great to have so many of you join us in our webinar series. I'm Renee Miller. I'm a partner at SW, and I'll be moderating today's session. And it's great to have so many of you here with us today. So firstly, I acknowledge the traditional custodians throughout Australia and the connection to land, sea, and community. And we pay our respect to the elders past, present, and emerging. Today, our presenters are just myself and Jimmy. So those of you who are regular attendees will see Tom's not here today. He's traveling in India for business, so he couldn't make it today. But Jimmy and I will hopefully carry the torch on our own. So I'm going to kick off today with a bit of an update on sustainability reporting. I'll also provide an update on accounting standard changes and give you the ASIC update. Jimmy will talk through the IFRIC findings and some other regulatory changes today. And hopefully we'll then have some time at the end for some questions. Just a little bit of housekeeping before we start. We recommend that you click on the Enter Full Screen button at the top right-hand corner to achieve the best webinar experience. If you click the Q&A button at the bottom of your screen, a window will pop up that will allow you to send us questions as we go. We will monitor these and answer any that we can during the presentations. Some we will save for the Q&A at the end of the session, but for more bespoke questions, we may need to connect with you after the session. We will also circulate the slides today after the webinar, and a recording of the webinar will be available on our website if you want to double check anything or share it with any of your colleagues who might be interested. Right, so I'm going to kick off with the sustainability reporting update today. Now, mandatory climate reporting, that is the hot topic at the moment that everyone's talking about. The bill received royal assent in September in 2024, so it's brand new, it's very exciting. So the bill received royal assent in September 2024, so brand new, hot off the press, even though we've been talking about it for a long time. So the final legislation was slightly different from the draft that we would have told you about in the past. And the big ticket change from the draft was this needing to include a climate scenario analysis. So the final bill requires companies to include at least two scenarios, one being a low warming scenario if global temperature rises stay below 1.5 degrees, and one being a high warming scenario if average temperature increase exceeds 2.5 degrees. So that's at least what you have to disclose. But obviously, if other scenarios will impact you, you can have more than that as well. So the proposed rollout, the final rollout, is very consistent from what we initially thought. The initial draft had us starting a year sooner. So this is consistent with the second draft of the legislation. So the first caps off the rank will be Group 1 entities with a 31 December year end. So they'll be doing 1 January 2025. So for 31 December 2025 will be their first reporting year. So if you're not sure which group you fall into, you have a look at your consolidated revenue, gross assets, and employees. You need to meet 2 out of 3 of these to determine which group you fall into. The exception is for asset owners. So if you have 5 billion of assets under management or more, even if you meet 2 or even 3 of these other criteria, you will be able to go a year later as if you're Group 2. So all asset managers with 5 billion of asset under management or more, even if you're Group 1, you're still Group 2, if that makes sense. So Group 2, the date goes from January to July. So if you're Group 2 and you're a June reporter, your first year will be 30 June 2027. But if you're a December reporter, Group 2 skips a year and goes for 31 December 2027. That makes sense. And then Group 3 will be 30 June 2028, 31 December 2028. So that's going to be really exciting for a lot of our clients to get onto the journey. The content of the report is the following. In the legislation, there's a climate statement, some notes, some other statements, and a director's declaration, and also an audit report. Let's talk a little bit about the audit rollout. So the audit standard is not 100% final. There's currently still an ED that's open until this Saturday for comment with the Australian Auditing Standards Board to comment on the latest. So this is the current plan for the rollout of the audit requirements. Based on the roundtable discussions that we've had with the AUASB, I'd say it's unlikely for this to significantly change. And they've done a lot of consultation, and in their, to their credit, they did take the comments on board from their first exposure draft until this current exposure draft. This has been a substantial change from what they first presented to us. And so they have very much listened to the feedback. And so they've pushed back the reasonable assurance requirement by a couple of years, because people were saying, we think it's a little bit unreasonable to have that so early on. So the key things, so you can see the priorities for assurance, is around the scope 1 and 2 emissions. So right up front, there's limited assurance, and you then go straight into reasonable assurance from year 2 onwards. Whereas some of the other areas of the sustainability report, some of your other disclosures will have at first no assurance, then limited assurance for 2 years before it goes to reasonable assurance. So even though this is still subject to change, I would say this is most likely to be what the final rollout is going to look like. Now, in terms of what you need to include in your sustainability report, that will be in accordance with the reporting framework that's determined by the AASB. So the Australian Accounting Standards Board determined what goes into the disclosures. And so the standards that they have issued and are now final are AASB S1 and AASB S2. So AASB S1 is voluntary and AASB S2 is mandatory, and these were based on the international versions, but amended in 2 quite critical ways. The international versions addresses climate disclosures, but also more broadly ESG disclosures, whereas in Australia, we're focusing on climate-related disclosures only. And so for AASB S2 to stand alone on its own for mandatory compliance, some of the definitions and guidance and so on from S2 has been moved in, from S1 has been moved into S2 to make it a standalone standard. So you can set compliance with that standard only without needing to comply with S1. So we're recommending to our clients, if you feel strongly you want to comply with both, then that's a reasonable choice. If you have European stakeholders, European investors, European headquarters, and a large footprint in Europe, you may want to consider complying with both, because that would be more consistent with what's being required in Europe. But if you're an Australian group, there's really no reason to comply with both these standards, and probably better to just, stick with S2 until you feel more comfortable with it. I've put our contact details on here of our sustainability team. If you need any help, give us a call. We're always happy to have a chat about what you need to do and how to go about it. The process, as we see it, is broadly a 5-step process. So first of all, prepare. That's going to be the secret to success. So figure out what group you fall into, talk to your auditor about the books and records you'll be creating, you'll be keeping, what your, kind of what your plan is and how you're going to get to stage 5, which is the goal, which is reporting. When you're preparing, you also probably need to talk to your stakeholders and get a feel for what your overall ESG goal is. Are you trying to just have minimum compliance with this reporting requirements, or are you trying to start a broader ESG journey where you might want to set some targets, maybe become carbon neutral? You might want to have broader, targets rather than just around carbon emissions. Whatever that journey might look like for you, have a chat, decide who on the board or what kind of committee will be responsible for it, what your governance around it is going to look like. So that's quite key as a first step. And then make sure the roles and responsibilities are allocated to those who you're going to be tasking with the job of doing sustainability reporting. And then you probably also need a bit of a project plan, a timetable, and so on. The materiality assessment is quite crucial here. So in Australia, our materiality assessment broadly follows what the general IFRS financial statement materiality is. I actually put it on the slide a couple of slides back. I might just skip back for you. So the definition is information is material if omitting, misstating, or obscuring that information could influence decisions that primary users of the financial statements make, including sustainability information. So basically, if it will impact an investment decision or the value of the entity, or if it will be a significant matter in the decision-making of key stakeholders, then it's material. That's quite a high bar if you think about it. So doing that materiality assessment and feeling really comfortable with it will be absolutely crucial, because I think everyone's go-to is to go, well, let's brainstorm and whiteboard the 20 or 30 things that can happen if global warming increases. Well, there's not going to be 20 or 30 things that's going to be material to your entity. It's highly unlikely that would be the case. So let's remember that the bar for materiality is fairly high, but you need to know what it is. You need to document it. The board needs to ratify it. And also needs to be an ongoing, open thing that can change over time as more and more information comes to light, and as you become more familiar with sustainability reporting. Next up is a gap analysis. You look at where you're at, look at where you're going and how to get there. That's something that Tom and I have been working with clients on, and we're happy to help you with that process. We're also helping clients with their materiality assessments, so give us a call if you need help. And only then do you get to the data collection and collation of your, emissions and the reports you need and the systems and processes and so on. And then finally, you can pull your data together and prepare your first sustainability report. Ideally, you want to target, if you're not in group 1, you ideally want to aim for maybe a year before it becomes mandatory to have a report. You don't have to publish that report on your website. You don't have to give it to any shareholders. You don't have to give it to anybody, but just as a practice run for the board to see where the gaps are might be a good idea. So the disclosures that go into the body of the report, I'm not going to read through every single bullet point here because there's quite a lot of stuff. And this is very much a snapshot. The standard is obviously quite a few pages, and a lot of these bullet points can be drilled into in quite a lot of detail. But at a high level, your disclosure requirements are around governance, strategy, risk management, and then metrics and targets. And that's how the standard is also, organized. And the key things around that is probably risk management, because that is the center of kind of what your climate-related risks and opportunities are, how the company is managing those risks and opportunities, how resilient the company is to those kind of risks happening, and then what your metrics and targets are around those as well. And those risks should also be considered with reference to your climate scenario analysis. And then in terms of resources available, we've for those of you who joined our webinar series, thanks for joining us, but the recordings of the 3 sessions we did this year are all available on our website. So if you've missed those, please feel free to jump on our website and have a look at those. Jimmy, Tom and I are doing quite a lot of alerts and publications and so on LinkedIn. So if you're not following us on LinkedIn, go for it. We're also going to have in 2025, we're probably going to do a monthly or every 2 months, a short form webinar, just 20 or 30 minutes where we tackle one topic per month, and we don't do any fluff around it. We just go straight, okay, here's the one thing we want to talk about this month, and just do a short form webinar. We'll also record those and put those on our website. So feel free to jump on our website and see what resources there are. But also have a look at the Clean Energy website. And that's the Clean Energy Regulator website. That's got a lot of tools on there that's going to be very helpful. And the Greenhouse Gas Protocol, which is what you need to comply with for your carbon emissions. Have a look at those. Right, so that's it for sustainability reporting high level. If you haven't yet started to talk to the board, shareholders, other stakeholders about it, I would say it's a very good time to start doing that as soon as possible. Now, with accounting standards, there's quite a lot happening in accounting standards as well. While the sustainability standards were in draft and were being developed, we had a bit of a lull there where we didn't have too many changes to the accounting standards, and it feels like that's not being caught up. So there's quite a lot of just minor changes, a lot of exposure drafts, a lot of annual improvements, all sorts of things happening. But the big one this year is the new standard that was issued, AASB 18. That's consistent with the International Accounting Standards Board version. And really what this standard is about, it's about trying to give a representation on the face of the P&L of how management sees the performance of the entity. So more closely align a management performance measure of how the entity performed with how you actually view it on the face of the P&L. So what people have been doing to date is in the director's report, companies will have a little table that presents how their non-IFRS profit was in the year. So the operating profit or, profit excluding exceptional items. So those kind of things that you can't actually include in your financial statements. A lot of companies have been disclosing that kind of information in the director's report, and then shareholders are confused about why is this different to the actual P&L. So this is now the standard set is saying, okay, well, why don't we reflect in the P&L a little bit more useful information that ties into how management views performance of the entity. So for now, the standard is only applicable to Tier 1 reporters, and not-for-profit entities that do Tier 1 accounts get a 1-year deferral. It is available for early adoption. For those of you that do Tier 2 accounts, so for simplified disclosure accounts, the AASB is looking into how this can be worked into our AASB 1060 standard, or what that would look like for a Tier 2 set of accounts. So really, it's just inserting some new subtotals on the face of the P&L, and just making sure that that's actually consistently then applied. So you don't have some companies doing the current version and other companies doing the new version. So the current way of doing it is going to become no longer the way of doing it. So it is going to be mandatory, is really what I'm trying to say. There's some other changes to the accounting standards. There's a few kind of annual improvements. This one at the top, classification of liabilities. We've been talking about this for, I want to say 4 years. Every 6 months we're telling you about it. This is now finally mandatory. And the other ones are quite minor and probably not impacting our clients too much. So I just want to remind you, if you do have liabilities that are classified as current versus non-current, the old wording said you had to have an unconditional right to defer settlement of that liability. The new definition says the deferral has to have substance. So it's kind of lowering the bar on what is a non-current liability. And the right must exist at the year end, but some additional disclosures might be required. There's no real change in the intention to refinance. So if you do have a current versus current, if you have a facility where you disclose some as current, some as non-current, just have a look whether your assessment of the classification is still valid this year based on the new standard wording. Right. Now with exposure drafts, there's quite a lot of exposure drafts happening at the moment. At the moment, we've got in Australia 3 open for comment that I thought I would bring to your attention. And there's one that was just published by the International Accounting Standards Board yesterday, an exposure draft that the AASB hasn't yet released, but will do shortly, I'm sure. So the first one that is currently open for comment in Australia is talking about the application of the equity method of accounting, because it can be quite challenging in some circumstances, especially when you change significant, like the percentage of ownership, and you go from not having significant influence to significant influence, or if you're retaining significant influence. So if your percentage share fluctuates, it can be quite challenging to determine what that accounting treatment looks like. So this is just clarifying that and giving some additional guidance on that. This one on the not-for-profit, this is quite interesting because it's been a long time coming. It's been on the work program for a while, and this is very Australian specific. And so this is 2 exposure drafts, and they're really related to the same matter. And that matter is to remove the ability of not-for-profits of a certain size to prepare a special purpose financial statement. So it's bringing the medium-sized ACNC reporting charities into the framework that other companies, Tier 1 and Tier 2 companies in Australia are currently complying with, but also acknowledging that it's a not-for-profit entity. And so the second exposure draft is saying, well, should we actually create a Tier 3 for not-for-profit entities and have a look at not just the disclosures, but even, some of the recognition measurement requirements of Tier 1 or a Tier 2 entity, is that excessive for a charity that's between 500K of revenue and 3 million. So it's quite small compared to private companies. It's a small amount of revenue, but because it's a charity, there's still some reporting required around that entity. So I think the AASB is mindful of not creating an enormous reporting burden for not-for-profit entities of that size. And so they're looking at a completely new reporting framework, a tier 3 set of accounts for entities, for charities that fall into that size. Not just charities, but other not-for-profits as well. So that's open for comment. If you're a not-for-profit and you feel strongly about this, it's a good one to comment on between now and the end of February. And then the International Accounting Standards Board just released this exposure draft yesterday or a couple of days ago. And that's really around accounting for provisions. And it talks about some clarifications to the definitions, some consistencies around what does present obligation as a result of past events really mean. But it also talks about the costs that you can include in estimating future expenditures that you'll require to settle the present obligation, and also the discount rate that you have to apply to that. So that's not been issued by the AASB yet, but if you feel strongly about that one, you can comment to the IASB. And there's some other exposure drafts that we've had over the last few months that have now closed for comment, but are likely to become part of our standards, I suspect, depending on how the comments went. We've got a few of those. So and a lot of the exposure drafts, a lot of the changes to accounting standards at the moment are around two key things. One, to address the fact that there are some financial instruments that are out there around, just some new products, but also products that, or situations around renewable energy. And those things are really difficult sometimes to interpret in light of the existing standards. So a lot of the exposure drafts, a lot of the changes that are happening are to put those new financial instruments and those renewable energy contracts and so on into the existing frameworks. And then the other thing is sustainability related matters, how that goes into our accounting standards as well. So that's a lot of the changes are around those kind of things. So with this top one, that's really looking at some financial products that are new and have new kind of characteristics, where they should be classified as equity or liability, and just giving some clarifications around some of the things you need to look out for in determining the classification. The second one here is a result of the post-IFRS 9 implementation review. And it's really just some clarification around what to do where settlement is by electronic payment. So it's just some things that preparers had some issues around, some questions around. Now, this one at the top, that's really interesting. That's going to, I think, have a big impact on a lot of our clients who have business combinations and disclosures and goodwill impairment models and so on. And really, what's the feedback that came through from users of the accounts to the International Accounting Standards Board was that a lot of the time, by the time there's an impairment to goodwill, it will be a few years after an acquisition. And because goodwill is assessed on sort of a discounted cash flow model, you're looking at future cash flows. If it's underperforming in the first year, or the second year, or third year of acquisition, it's unlikely to result in an impairment because management is looking forward to how they believe it will perform, but it doesn't always perform as expected. And so by the time there's an impairment, investors had no idea that acquisition was underperforming. And so what this exposure draft is recommending is some additional disclosures around the performance of a business that was acquired, but also there's some targeted amendments around how that discounted cash flow will be or can be calculated in terms of the value in use calculation around that acquisition. So that's going to be quite interesting and should have an impact on, well, most companies who have goodwill after an acquisition of a business under AASB 3. And then this last one here is just around the climate related, some examples that go into IFRS 18 around some uncertainties when there's climate related matters and how that's disclosed in the financial statements. Some contracts for renewable energy, renewable electricity can be really difficult to classify under AASB 9 and disclose on AASB 7 because it doesn't meet the clear definitions of what those financial instruments are. Because if it's nature dependent, supply cannot be guaranteed. How is that accounted for? So this one just provides some clarification there or some additional guidance there. And then we also have just this one around some classification and measurement of financial instruments in Tier 2 disclosures. So it's just some new disclosure requirements for financial instruments in a Tier 2 set of accounts. And that's really it. That's a bit of a snapshot on what's happening. Jimmy's going to talk to you about some IFRIC findings as well, which also impacts the accounting standards.
Thank you, Renee. So I want to talk to you about IFRIC update. So before I start talking about that, I want to just have a brief introductions of IFRIC. So not many people kind of know exactly what they do. So IFRIC stands for IFRS Interpretation Committees. So this is a mechanisms to help consistent applying the accounting standard across the board. So what's happening is when people come across new emerging issues that the accounting standard doesn't specifically address. So how do they apply those things in the accounting standard using the accounting standard? So people will submit their question to IFRIC, and then they will publish their decisions. And why are we talking about those things? Because the IFRS standard actually say the IFRIC decision form part of the accounting standard. How do you apply those accounting standard? You actually need to look at what IFRIC has already published, and also looking at some of the recent IFRIC decisions. It's quite interesting. It's really echoing what Renee just has mentioned. A lot of the application of the accounting standards. We're not talking about sustainability reporting standard, the one it's coming, but we're talking about the current existing accounting standard. A lot of those is to address the question coming out from climate change, coming out from the transitions to net zero. So it's quite interesting. So today I want to talk about two specific IFRIC findings. So both of the topics I'm going to address today is actually linked to one specific accounting standard, that is provision standard. So before I jump into the two examples, I want to just do a quick recap of what is a provision. So what's the requirement? Where do we book the provision? So a provision is a liability of uncertain timing or amount. So you do need to have the uncertainty around it. For you to book provisions, you need to tick off 3 boxes. So the first one is you need to have a present obligation. So the obligation can be a legal obligation or constructive obligations. So you need to have a present obligation arising from a past event. So you have done something, right? So to make you liable to the liabilities. So this is item number 1. The second one is it's expected to have economic outflow, and it's probable to have the economic outflow. So the probable is defined by the accounting standard. It's more than 50%. So this is 1 and 2. The third one, they do put it there, but in practice, it's people just think it's a given. So it is when things is reliably measured, and the standard does say, usually that's the case. Only in very, very rare extreme situations, you may not be able to reliably measure. But in practice, typically this is a given. So once you tick off these 3 boxes, you are required to book up provisions. So now with that background knowledge, let's look at some interesting examples. So the first one is about companies' commitment to to net zero target. They put out a target. So a company, they say, okay, we are going to reduce our carbon emission by 60% at X day. And to do that, they actually put out quite detailed plan, in their communications, in their website, exactly how we are going to do that. So it's quite detailed plan. And they say, if I'm not able to do that, I'm going to acquire carbon credit and I'm going to retire them to offset against my emissions. So the questions come like, do I then book provisions when I put out this public statement, when we announce that we're going to reduce the carbon? Just think about it. Eventually, you will need to pay money in some shape or forms, right? So do we recognize the provisions at reporting date? So that's the questions. I'll give you 1 second to think about it, right? So the answer is no. I want to give you the answer first before I give you the analysis. So you don't book in a provision when you put out this announcement, when you publicly announce that we're going to reduce our target. So going through the thought process, 1, 2, 3 categories. So the first one is to determine if you have obligations. So the standard, the IFRIC people, they actually acknowledge whether or not your public statement constitute a constructive obligations. It requires judgment. It really depends on exactly how do you communicate, what details do you say, that's judgment call. But then they go on further to say, okay, even you conclude you do have a constructive obligations, you don't book a provision. The reason is the public statement is not a past event that creates a present obligation. So what is then? It will be when you actually emitting the carbon that you promise to reduce. At that time, you will then recognize the liability. So think of different examples. We have environmental protection rules, right? You wouldn't book in a liability until you actually done something to the environment. At that point of time, you will then need to assess whether you have a liability. So it's a kind of similar vein. Right. So this is one, but I also just want to take the opportunity just to remind everyone. So although you don't book a provisions when you publish those plans, when you want to reduce your carbon emissions, but it does have other implications in your financial reporting. So the first one is around impairment, right? If you are saying, okay, we're going to reduce, are you going to still use some of the asset? Is there a material impairment indicator for your assets? And do you also need to relook at your asset useful lives? You may not be able to use 20 years of the assets. You may have to accelerate the depreciations. And also, how do you account for carbon credit? Right, that's something we don't have an accounting standard around it. Yeah, so exactly how do you account for it? That's something you really need to consider. And your emission, your target is going to be a very critical portion for the sustainability disclosure, as Renee just told us about. And lastly, there is a project, as Renee mentioned 2 days ago, they published this updated provision standard. How is the future changing standard going to affect, the commitment? Really need to look into a little bit more details around it. All right. Then let's move on to the next examples. So it's also around emissions. So in this fact pattern, so country A In fact, this is China. So from the feedback from IFRIC people, this is submitted from China. So what they do say is the country want to reduce carbon emissions, so they put in the policy to incentivize car manufacturer to produce or import cleaner car. So if you do that, you will get a positive score. But if you are producing or selling, importing the more traditional car, you're kind of being penalized. You get the negative score. So at the end of the day, you are required to settle your score. If you have a negative score, you kind of have to buy carbon credit from other company to offset, to settle your negative score. So the question is, do I then book in a provision when I produce the car, when I actually have the negative score? Do I have to do that? So in this case, the answer is yes. So just apply the same principle, apply the same thought process from previously. So you do have an outflow of economic benefit. You have to buy someone else credit. You have to pay money for it. And the trigger point is really when you produce the car, when you actually import the vehicle, that's giving you the negative score. So this is very important to remember. So you can see the complexity around applying the existing accounting standard in those emergent topics. And that's why the IFRS people has been busy coming out with the new exposure draft to clarify things. All right, so I have told you about the IFRIC update. So now I would like to hand over to Renee to give you the ASIC, to see what they're up to.
Great, thanks, Jimmy. Hopefully I'm sharing my slides this time. So just an update on what ASIC is saying in the surveillance program. Look, the focus areas have not really changed in recent times. It's not that surprising because the areas that they focus on are those areas where there's uncertainties, risks, judgment, those kind of things. And so the main area, as you would expect, is around asset values. That's always a focus area. I can't even remember when it wasn't. Provisions, appropriate provisions, some subsequent events, disclosures, the new insurance standard, and some other matters. Now, some of the other matters that they, in their most recent media release on their surveillance areas, that they included were sustainability-related matters, grandfathered companies lodging their financial statements, the new insurance standard. So those are the kind of areas that they consider the other areas that's important at the moment. And so the interesting thing, though, what is new is a few months ago, they published a media release saying the context in which they look at those risk areas that we just ran through, asset values and so on, is no longer, so previously, and especially during COVID and after COVID, the context in which they said companies need to consider those risk areas is the context of the global economy, COVID-related supply chain issues, interest rates, those kind of things, inflation, those kind of macroeconomic things. Now they've said the context in which companies need to consider those judgments that they're making are in the reporting process. So directors have to take prime responsibility for the estimates and judgments in the financial statements. The quality and the timeliness of financial information is really important so that the directors can make proper judgments. Robust position papers. As an auditor, when we have a significant and material risk as part of an audit, we usually say to clients, oh, do you have a position paper? And quite often they don't, and then we have to help them write one. And this is where Jimmy comes in. This is Jimmy's main thing, is writing robust position papers. But that's the kind of thing that when ASIC looks at an audit file, or where they go into a company and they look at their books and records, they expect to see robust position papers that the directors have reviewed and that the directors understand and have approved. And, so it's a considered process before a judgment is just made. So if I think about an example, If a company acquires, let's say they invest in a particular financial asset, how you account for that financial asset can significantly influence the value of it. So whether it's allocated as amortized cost financial asset or fair value through profit and loss, depending on the characteristics of that asset, can significantly influence the value of it, how it's accounted for, how it's presented in the financial statements. So that kind of determination can't just be made on the fly by management as you go, if it's material. Obviously, if it's immaterial and a small matter, it doesn't matter so much. But if it's a material financial asset in the balance sheet, then you'd expect to see a robust position paper, how the future cash flows from that asset has been considered and concluded on what the business model is for holding that asset, and so why the directors can conclude what the appropriate classification is, that sort of thing. So you'd expect to see a proper position paper that refers back to the accounting standards. Some other matters to think about is, when you do have a complicated financial reporting matter, look at the accounting standards, have reference to the accounting standards in your conclusions, in the board pack, so that the directors are aware of why they're accounting for something the way that it's being accounted for. Make sure that your team, your management team, your finance team have the appropriate experience and expertise. And if they don't, that's fine. If you've got a significantly complicated matter that your management team have not dealt with before, then having a consultant help you address it or how to deal with it is a good way to add that experience and expertise to the team. The focus needs to be on the difficult and complex areas, not the routine day-to-day things when it comes to governance and decision-making and financial reporting oversight. Judgments, estimates, forward-looking information, those types of things can be really complex and can have material impacts on the financial statements. So how a company addresses those things is absolutely critical, how it's documented and disclosed. The OFR for listed companies really should tell the story of the year. It really should not be boilerplate at all. And it really should be quite tailored and personalized and, specifically say exactly, what the process was in the year, how things unfolded, strategy, those kind of things, the day-to-day story of how the business went for the year. And any underlying drivers should be explained properly in the accounts and disclosed properly. Forward-looking information needs to be reasonable and disclosed. Audit fees should reflect the additional audit effort where there are significant matters. Now, I didn't make that up as an auditor. That is what ASIC did say. And so the kind of things around asset values to look out for: impairment of non-financial assets. That's always a significant judgment area, in particular in a climate where some non-financial assets, like valuation of property, for example, some commercial property have performed very different to other commercial property in different locations. Residential, commercial have had very different market conditions. So, it's been a very uncertain kind of market for property values, and therefore that becomes a really big focus area. Some expected credit losses where credit might be tight or where customers might be struggling with the cash flows or whatever the circumstances might be. Some other assets like inventory, net realizable value of inventory could be impacted. Those kind of things are not just things to think about, but things to document and disclose properly and for the board to be across as well. And like I said earlier as well, the financial asset classification is quite critical to how it's accounted for. And so coming to that conclusion is quite crucial. Then we've got some provisions. So own risk contracts, that's not one we see that often, I don't think, but recently we did actually deal with a client who did have an own risk contract, and was quite nice to revisit how that's accounted for, because I haven't dealt with that for a little while. And restructure provisions, a lot of companies are actually restructuring. There's a lot of transactions happening, a lot of people say, having a look at what are the performing parts of the business, what are the underperforming parts, and let's restructure. So a lot of that's happening at the moment, and accounting for those provisions around restructure can be quite complex, but also might need some judgment. Make good provisions, really important. Mine site restoration and provisions for any financial guarantees are crucial types of provisions. Around disclosures, as accounting standards seem to be becoming a lot more judgment-based, there's a lot more, principle rather than rules-based. Disclosures are just really important, and I would say the less boilerplate disclosures you can have in your financial statements, the better. And the more you can just focus on the material disclosures and just get rid of some of the clutter in your accounts, the better. And that's not just my opinion, that's actually in the latest AASB standard on material accounting policies rather than, significant accounting policies. I feel like the standard setters, everyone are moving in the direction of requiring preparers of the accounts to focus on the material matters, because a lot of the time you look at a set of accounts, just so much clutter and so much unnecessary information in it, and it can be very difficult as a user to sift through that and to pick out the bits that's actually significant and that's actually important. And I think this is what ASIC's trying to say as well. Some non-IFRS information can be misleading and is actually not allowed. So probably best to remove those. Look at your current and non-current classification, like we said earlier as well. And the OFR is really important to ASIC. And some of the media releases and some of the actions taken by ASIC recently. Vanguard was fined 12.9 million for greenwashing recently. I'm sure that's not a huge deal of money to them, but that's still not something I think you want your brand associated with. And Mercer was fined a large fine as well. Now, what happened there was, I don't think it was any malicious wrongdoing. I believe there were some funds who said they had green energy assets only, but then had some mining, I don't know, some non-green assets as well. And so I think what companies need to do is they need to take ownership of what they're disclosing to the market, but also what they're putting in product disclosure statements, what they're putting in their marketing brochures out to the market. Those things need to be consistent and considered, because if you're saying something is, a certain level of carbon emissions or doesn't contain certain materials or whatever, that actually needs to be correct, because ASIC seems to be really taking this greenwashing matter quite seriously. There's a lot of action, as usual, a lot of action against SMSF auditors and against financial services licensees. I mean, to ASIC, it's always really top of the agenda that financial services providers are regulated properly and do the right thing, because, they deal with other people's monies. A lot of actions against directors, some banning of financial advisors. Those seem to be the main actions that ASIC are taking at the moment. And that's it for the ASIC update. Jimmy has a couple of other regulatory matters that he wants to run through today.
Yes, thank you, Renee. So there's a couple of other things that don't sit in the accounting standard vein, but I want to just draw your attention. Some of those is quite applicable in the in the reporting space. So the first one is the very interesting one: crypto assets. Like, this is the assets we commonly heard: the Bitcoin, Ethereum, those type of crypto assets. So, like some of the emerging transactions, there is not a specific accounting standard to address crypto assets. So people have already asked the IFRIC, hey, how do we apply the current accounting standard? Should this be accounted as a financial asset, as an investment, as a inventory, intangible? How do we do it? So, and the IFRIC has already published their agenda decisions around this topic. So they look through the existing accounting standard, they think through the definition of a financial asset, and they have concluded the more appropriate way to account for crypto assets is either you hold it as an inventories. So again, it really depending on your business model. If you're trading the crypto assets, you may treat it as a inventory, or you may put it as a intangible assets. And just pause for a second. They didn't say you can do that as a financial asset, because a lot of the time people does kind of default to financial assets. I think a lot of people think they can, immediately exchange that to cash, but they say just looking through the whole whole transactions, looking at the background, looking at the definition, they are not financial assets. So this is for international reporting standard that Australia also follow. That hasn't changed, but during the year, in the last 12 months, US, they actually published their own accounting guidance around cryptocurrency. So they actually say you should account for it at fair value through P&L. So that is a very similar way as accounting as an investment, accounting as a financial asset. So obviously in Australia, we don't follow US GAAP. The reason I want to draw this to your attention is you may have a US parent, or you may hear people say, hey, I hear this thing in the US, we should do fair value to P&L, but at least now you know there is a difference between the two accounting standards around this particular topics. All right. Shifting gear a little bit. So now we are now we're talking about Corps Act. So under the Corporations Act, that's a new update, new requirement for a public company. So when I talk about a public company, so that is both listed or unlisted public company. So I often just think this way: does the name of the company have a PTY in it? If I have a PTY, it's more proprietary company. If it's not, maybe you are a public company. So if you are a public company, you're required to produce this new consolidated entity disclosure statement. It's very mouthful. So what do we do? What is the new statement do? So essentially, you need to have a new statement to include all the subsidiaries that's included in your financial statement, right? So everything that you consolidated into your books, you need to detail them. That's a bit more prescriptive, exactly what you need to say, the very important one, not only their name, the percentage, you also need to disclose what is their tax residency. So what was like, what I thought we were talking about accounting, why we suddenly talk about tax? Yes, the reason this new legislations, the reason that we have to do this is actually introduced from tax. So this is part of the anti-tax evasion measurement the government put in place, to make sure that big corporations, they are being transparent, you are able to trace what's underneath, what are the tax structure in place. So they introduced these legislations to improve the transparency around the disclosure of subsidiaries. So this particular legislation already effective. So we have worked with many of our clients for our June reporting period, and there is quite a fair bit of work going to that, especially you have a lot of subsidiary, and determining the tax residence sometimes can be challenging. And also just, knowing these things has to be prepared, has to be drafted. And in the director's report, in the director's declarations, you actually have to add in additional sentence to say, hey, this particular report, this particular statement is true and correct. So this is a higher bar as compared to your normal financial statement, which is true and fair. So now they basically say everything that you show in the statement is true and correct. So that's quite a lot of work to make sure everything is correct. And the auditor will need to audit the statements, obviously. And if you are a listed company, so your CEO and CFO will need to include an additional sign-off to the board around this statement. So this is also specifically required by the legislation. So For our December reporters, if you're a public company, please be mindful of this legislation. It will applicable to you for the first time. All right, this is what I have, Renee.
Right, thanks, Jimmy. Look, I would say if you're a public company and you're a 31 December reporter, maybe just reach out to your audit team or to Jimmy early on in the process, because we've got some templates around the consolidated entity statement and around the director's declaration that you need to do. So we can help you with that. Look, we've only received one question, so I can only assume that means we've covered everything in sufficient detail. But the one question is something I forgot to say. So let me read out the question. Could you please confirm for a not-for-profit organisation in Group 2 with a December year end, when would we need to prepare a sustainability report? So first of all, I didn't clarify when I shared the table with you that the size requirements, the 2 out of 3 size requirements, only apply to those companies preparing accounts under the Corporations Act. So if you're a not-for-profit organisation that reports under the Corporations Act, then those size requirements apply to you. If you're not reporting under the Corporations Act, if you're reporting under the ACNC Act, then the ACNC have not yet said when or if their reporters will need to comply with sustainability reporting. But yes, if you are a Group 2 company, not-for-profit entity, and you're reporting under the Corporations Act, then yes, it'll be 31 December 2027. So Group 1 for December year ends will be 31 December 2025, but then Group 2 skips a year and goes to 31 December 2027, Group 3, 31 December 2028. So I hope that answered your question. Right, we didn't receive any other questions, and we have actually run out of time as well. So thanks so much, Jimmy, for joining me today, and for all of you for being here with us today. We'd love to hear from you. If you have any questions, please speak to your usual SW advisor or send through your queries to myself or Jimmy, and we'll send you the slides after the session. We'd also value your feedback on the session, so please complete our feedback survey, which will pop up on your screen at the conclusion of this webinar. Keep an eye out on LinkedIn and our website for details on our sustainability reporting webinar series in 2025. Otherwise, we'll see you at the next IFRS update. Thank you for joining us and have a great afternoon.